The global economy has never been bigger. More money exists today than at any point in human history. More wealth has been created in the last 30 years than in the previous 3,000 combined. The numbers, GDP, market caps, total assets, global output, they just keep climbing. And yet, ask almost anyone under 40 whether their financial life feels easier than their parents did at the same age. The answer is almost universally no. More money in the world, more pressure in your life. More wealth is being generated every single year. Less breathing room at the end of every month. That contradiction isn't a feeling. It isn't ingratitude. It isn't a failure of perspective. It is a structural reality. And it has a precise explanation. By the end of this video, you're going to understand exactly why economic growth and personal financial ease have stopped moving together, the mechanism that separates them, who benefits from that separation, and what it means for the choices in front of you right now. The economy is not broken. It is working exactly as it's currently designed. That's the part worth understanding. For most of the 20th century, when the economy grew, most people inside it felt it. This wasn't idealism. It was mechanics. Productivity growth, the increase in output per worker per hour, translated relatively directly into wage growth. Companies made more. Workers earned more. The gains moved through the system. Between 1948 and 1973, U.S. productivity rose by nearly 97%. Hourly compensation for workers rose by 91%. The numbers tracked almost perfectly. You didn't need to own stocks, real estate, or a business to participate in economic growth. You just needed to work. The paycheck was the mechanism. Then, the link broke. Between 1979 and today, productivity in the U.S. has risen by over 60%. Hourly compensation for typical workers has risen by less than 18%. Same economy, same workers, radically different distribution. The pie kept growing. The slices stopped being cut the same way. And that single shift, the decoupling of productivity from compensation, is the foundation of almost every financial frustration people feel today, but struggle to name. Here is where the money actually went. When productivity gains stopped flowing into wages, they flowed into profits. Corporate margins expanded. Shareholder returns increased. The gains that once moved horizontally from company revenue into worker paychecks began moving vertically instead, upward, into the capital. And capital compounds. A dollar of profit reinvested into a business generates more profit. A dollar of earnings reinvested into stocks generates more earnings. Real estate appreciates and generates rent. The return on capital, the rate at which owned assets grow, has historically outpaced overall economic growth in almost every measured period. Which means that if you own capital, you grow faster than the economy. If you only supply labor, you grow with the economy at best. This is not a moral argument. It is closer to a mathematical one, and its consequences are visible everywhere. The S&P 500 has returned an average of roughly 10% annually over the past century. A person who held $100,000 in broad index funds in 1980 would hold over $7 million today. A person who earned wages in 1980, saved diligently, and kept money in savings accounts would hold a fraction of that because their savings earned 0.5% while inflation quietly eroded the rest. Same 40 years. Radically different outcomes. Not because one person worked harder, because one person owned something. But here is the layer that makes this personal rather than abstract. The costs that define a stable life, housing, healthcare, education, childcare, have not risen at the general inflation rate. They have risen at multiples of it. U.S. home prices have increased by over 400% since 1980, consistently outpacing wages. Healthcare costs have been rising at twice the general inflation rate for 4 consecutive decades. College tuition has increased by over 1,200% since 1980. These are not random categories. They are the specific sectors where supply is structurally constrained, where pricing power is concentrated, and where demand is essentially inelastic, meaning people need them regardless of price. These sectors absorb wage gains faster than they arrive. You get a raise, rent goes up, insurance premiums increase, the raise disappears before you feel it. More money in the economy, higher costs at the exact pressure points of your life. The growth is real, the relief never arrives. Here is the part that makes the frustration legitimate rather than just emotional. The tools available to participate in the upside of economic growth, stocks, real estate, business ownership, all require capital to enter. And they compound most powerfully over long time horizons. Both of those requirements systematically favor people who already have wealth over people who are trying to build it. A person who inherited $200,000 at 25 and invested it passively has a fundamentally different relationship to economic growth than a person who earned $50,000 a year, paid rent, covered healthcare, serviced student debt, and tried to save whatever remained. Both people live in the same growing economy. One is carried by it. One is running against it. The advice most commonly given, invest early, compound long, be patient, is mathematically correct and practically inaccessible to a significant portion of the population, not because they lack discipline, but because compounding requires principle. You cannot compound what you do not have. You cannot take a 30-year time horizon when an unexpected expense can reset everything you've built. The tools work. Access to the tools is not equal. So what do you actually do with this? The first and most important shift is from thinking in income to thinking in ownership. The divide driving this entire dynamic is not between people who earn a lot and people who earn a little. It is between people who own productive assets and people who don't. A fractional share of an index fund is ownership. A small piece of real estate is owned. Equity in a business is ownership. These are not get-rich-quick instruments. They are the mechanism through which economic growth actually reaches the people participating in it. The size of the initial position matters far less than the category shift itself. The second shift is understanding which costs to fight hardest. Housing, healthcare, and education are the categories that consume wage gains before they compound. Every dollar redirected away from those costs through geographic choices, through negotiation, through structural decisions about how you live is a dollar that has the chance to work for you instead of against you. At the macro level, this conversation is no longer confined to economists. The decoupling of productivity from compensation, the concentration of asset ownership, the structural inflation of essential costs, these are now mainstream political questions in most developed economies. What the answers look like is genuinely contested, but the problem is no longer seriously disputed. More money is being created. The question of who it reaches is entirely a matter of structure, policy, and ownership, not effort. So why doesn't life get easier when money keeps increasing? Because economic growth and personal financial ease are governed by different rules. Growth measures the total size of the pie. Ease depends on how the pie is cut, and cutting is governed by ownership, by bargaining power, by the structure of which costs rise and which wages don't. For most of the 20th century, those two things moved together closely enough that the distinction didn't matter much in daily life. Then they diverged. And the gap has been widening steadily ever since. Knowing this does not automatically change your circumstances, but it changes where you direct your energy. Stop trying to save your way into a system designed around ownership. Start finding ways to own something, anything, inside it. That is the shift. It is not easy, it is not fast, but it is the right problem to be solving.